Today, we will talk about credit-linked notes, a financial instrument that allows the transfer of specific credit risks to credit investors. A credit-linked note is a type of security that has an embedded credit default swap, allowing the issuer to transfer certain credit risks to credit investors. These notes are created through a special purpose vehicle, SPV, or trust, collateralized with AAA-rated securities. Investors buy credit-linked notes from a trust, receiving a fixed or floating coupon during the note's life. In exchange for taking on specific credit risks, investors generally earn a higher return compared to other bonds. Credit-linked notes are backed by specified loans, which carries an inherent risk of default. To create a credit-linked note, a loan must be issued to a customer. The loan may be held by an institution to earn interest or sold to another institution. If sold, the loans are divided into parts by an SPV or trust, which are then used to create securities that investors can purchase. Investors receive par at maturity, unless the referenced credit defaults or declares bankruptcy, in which case they receive the recovery rate. The trust enters into a default swap with a deal arranger. Credit-linked notes operate like bonds, with payments made semi-annually, but are accompanied by a credit default swap. The SPV or trust pays the dealer par minus the recovery rate in exchange for an annual fee, passed on to investors as a higher yield on the notes. The coupon or price of the note is linked to the performance of a reference asset, providing borrowers with a hedge against credit risk and giving investors a higher yield for accepting credit risk exposure. The use of a credit default swap allows issuers to transfer default risk to other parties, functioning similar to insurance. Investors generally receive a higher return compared to other bonds, compensating for the additional risk. In cases of default, all involved parties including the SPV or trust, investors, and sometimes the original lender are at risk for losses, varying based on the number of loans involved, the rate of default, and the investors participating. Here are 4 key takeaways. 1. A credit-linked note allows for the transfer of specific credit risks to credit investors, typically earning higher returns. 2. A credit default swap permits issuers to shift their credit risk to another investor. 3. Credit-linked notes are used to hedge against specific credit events that could lead to financial losses. 4. Investors generally earn a higher yield on credit-linked notes to compensate for the risk of specified credit events. Hope this would help. Thanks for watching.